So take us through your journey. So what else, what other indicators you look into a sponsor to make sure that you're investing with the right person?
Yeah, a couple highlights that have really pronounced themselves,
Mm-hmm.
particularly over the last 2 years, Vinky. And thank you for sharing that comment on the pattern observation. That learning is such a on point comment because, yeah, humans, man, we are deeply habitual, and that includes the professionals that are out there. So that's why the second of our big buckets is approach. And what approach really means, to break it down more specifically in business language, is like uh, repeatable business process.
Mm-hmm.
And if someone can go and buy a storage facility, like we invest heavily into self-storage. We've done this with multiple sponsors over the years. It's treated us very well. And when they buy that storage facility, are they buying it climate controlled? Are they buying it not climate controlled? Are they going to do a certain playbook introducing technology to modernize the storage facility? Do they already know the vendors they're going to use? Because they're going to need something like 15 to 20 of them, to look
Mm-hmm.
holistically at when they go modernize a self-storage facility.
Mm-hmm.
Do they have the relationships, and how do they handle insurance premiums? Do they have relationships with insurers? The list is endless.
This is the Real Estate Vibe Show, and I'm your host, Pinky Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. And today, I have a very special guest, Spencer Hildors, with me. So, welcome, Spencer, to the Real Estate Vibe Show.
Oh, thank you so much for having me, Vinky. Really proud to be here.
Likewise. So, a little bit about Spencer. Spencer is a CEO and co founder of Madison Investing. After a successful 13 years of leadership career in Silicon Valley tech companies, Spencer transitioned into real estate investing, deploying seven figures of his own capital into passive investments over the course of 7 years. Through Madison Investing, he offers fellow investors access to niche opportunities in cash flowing assets like self storage, multifamily properties, and private credit. Spencer's mission is to help others achieve financial freedom through strategic passive investments. So, today our topic is really, really interesting, and that's gonna interest everyone, I think, whoever's gonna tune in. And the topic is how to vet sponsors in 2025 in this year. I think this is gonna be very much fun. So, vetting sponsor is very critical step in passive investing real estate because we need to know the person who we're investing with. And sponsors, they're also known as general partners, operators. They are responsible for acquiring, managing, and eventually selling the investment properties on behalf of investors. So basically, they are making the decisions for the investors or on behalf of investors. So evaluating a sponsor's track record, financial stability, team expertise, and transparency is essential to ensure that they are effectively managing the investment and delivering the results that we are expecting. So proper due diligence in vetting sponsors helps mitigate the risk and aligns your investment goals with the trustworthy operators or the sponsors, I would say at this point. So we're going to be talking about this with Spencer. So Spencer, I'm going to ask you this question. Um, from your experience, from your personal experience, can you take us through your journey? Like, how did you vet the sponsor first time?
Mm.
So let's start with that. What was the key thing that you look for when you started the first investment? Because I read in your bio, like you put like seven figures of your own money into the real estate investing to get started with.
Yes. Yeah, happy to. And for context for folks, these days I live here in the Bay Area, California, as you and I were chatting about offline, Vinky, and it's just a joy to be able to focus on this as my primary professional focus. I was in tech companies for 13 years. I know you and I both share a common journey in our tech prior to getting in so deep into private equity and investing. But being able to look at these opportunities to connect with hundreds of passive investors that are in our investing club at Madison Investing, like it's a joy to work on. But my goodness, like you think you know what's going to come the following year every year. You think you know what's going to happen in the market, ups and downs. everyone qualifies their forecasts and their comments when talking about investing because they should. Like, I don't have a crystal ball. However, you do get learnings, hopefully the good way, by seeing great
Mhm,
deals. Sometimes you get learnings the hard way, you know, and I think the last couple of years in the market, particularly as we've seen, you know, 2022, maybe the second half of that leading through 2023 and certainly through now, we're seeing cracks in the armor of the market. And so there's truly battle testing moments happening for so many of these sponsors that I've invested in alongside our members at Madison Investing. So our framework, when Jennifer, my co-founder and my wife, when
mhm,
she and I first started investing as
mhm,
LPs, we had already built up a little rental portfolio like so many people go through,
mhm,
right? We had bought the local rental, overpaid for it. We bought a small portfolio of rentals in the Midwest, and then we said, okay, there's a lot of overhead involved in owning rentals. Like we were getting good cash flow, getting some good appreciation on the California rental, um,
mhm,
but we were still doing more to manage the manager on property managers we had hired for these
mhm,
rental properties. And so we were like, where's the passive side of being passive here? You know,
mhm,
rentals are semi-passive at best, in my opinion. Still good investments, but like
mhm,
we wanted something because we have a couple of young kids. We had at the
mhm,
time, I was working full time in tech companies. Jennifer was working full time navigating an incredible career in CPG companies. And so I was devouring education. And this
mhm,
is before I even get to our five-part framework, which is in these buckets. The five-part framework is basically looking at the sponsor's track record, number one, number two, their approach, number three, their team, number four, the communications, and number five, their values. And we'll get to that in a moment. But
mhm,
even before that, I was like, I need to learn a lot. You know, I'm the kind of guy who doesn't like to just jump in blindly if I'm going to go take on anything in life. And I learned a lot of those lessons from my career in technology companies across companies like Intuit, Gusto. These are financial tech companies that work on the guts of small businesses and back office. So I like to prepare as much as I can
right,
operationally.
right, uh-huh,
It's a good thing. And so we went out and said, okay, like, let's go. And I listened to over 400 podcasts, just like yours, like quality education, getting into it. In the course of 18 months, I read 24 books, and no one needs to do that to that degree. Like, I don't think a new LP needs to get as obsessed as I did.
mhm,
However, you got to get down to the basics. And so I educated myself. I also had a unique advantage of being inside my W-2 role at the biggest tech-enabled private lender in the country. So I was working at Lending Home, and now they're called Kiavi. And
mhm.
I was brought in to lead their loan origination teams, and we were doing 600 loans per month
Wow.
to fix and flip investors. And I'm not a flipper. I
Mhm,
cannot swing a hammer at all.
mhm,
I use YouTube to fix basic stuff around the house, but I did see the opportunity to go invest in these bigger assets like multifamily apartments in the
mhm,
Sun Belt and also self-storage facility in a number of great markets in the Midwest and the South. So I went through this underwriting journey and learning underwriting, and I think I came out the other side looking like, okay, guys, we need to build a framework before we deploy this first 25K into a deal. We ended up finding one in Alabama. It's like a multifamily deal,
uh-huh,
and this was just for Jennifer and I, and we came up with those five buckets. And there's like
mhm,
a very nerdy 70 row spreadsheet in Excel, you know, which I won't
mhm,
bore people with here. But for us, it's like those five buckets of track record, approach, team, communications, and values. That was just to go and make sure that we didn't burn ourselves on that first investment. And so we,
mhm,
you know, to give a couple examples, like track record, what that means for most people is, and it should, is like, look at this team and see, have they done this before? You know, and way too general of a way to look at it now, I would say. It means not only track record, it means on their approach. Are they doing the same thing on this next deal? I'm going to put this 25K in, which eventually became for other deals like 50K, 100K, bigger amounts, right? Like, are they ready and poised based on experience in the real world on real assets to go run this type of business plan on this type of asset? Or are they kind of like getting distracted with shiny object syndrome, trying to go buy a new type of asset they've never done before? But we were really feeling good about the one that we invested in. You know, it ended up exiting in roughly 3 years on a 7 year plan. Clearly, that had to do a little bit with the market context as well, because 2021 was a heck of a good year
mhm,
on valuations. And so, you know, we were very pleased with how that one ended up. But I didn't know it was the beginning of this journey to now have invested in dozens of LP positions, you know, in multifamily, self-storage, mobile home parks, medical office, private credit, like that, which is the number one focus for us right now because of the market context. And we can chat more about that later. But it's been a remarkable journey. But before that first investment, we at least got the first version of our vetting framework in place. And, thankfully that first deal worked out well.
Wow, congratulations. Oh my God, you were super smart and you created your own five-pack bucket, to vet the sponsor. I didn't even do that. And I just came from the similar background. I had a small little portfolio between me and my husband because we bought the second home, rented the first one, so learned about the passive income. We did exactly the same thing. And coming from the tech background, kind of understand the corporate world, the tech background, but didn't have this exposure to the passive investing, kind of hands-free investing. The other thing was you had the property manager to
Mhm.
manage your properties. We were like 100% DIY because
Oh, well, good for
I
you
just
though. You save the expenses, right?
I used to joke with my husband that we didn't even know that there was some company called property management company too.
Oh, okay.
Ourselves, basically. But we got burned out over the course of time. And then we learned about the passive investing. But my first investment was just like with my friend. And it was just like kind of blind focus. It's like, thinking that he did so well for the last 10, 15 years. What could go wrong? So I just put my 100K with him and just kind of ran with it. That's how I started. So, but
Nice.
kudos to you that you did your homework, which is pretty awesome. And you mentioned very good thing. The first step is to learn about the sponsor, the track record. Track record is very important. And for me, it's not just about the how many deals they had or how much it's more about like how much they have returned or how much they have exited. That's important, but how they're managing the deal. Because
Yes.
the thing is, I believe in that coming from the corporate world, you can resonate with me that you know how people form patterns and
Yes.
that becomes their innate nature. So regardless what they do, they're gonna fall into the same pattern. So it's not like that in the corporate world, there was somebody else, and now they're gonna come to the real estate, all of a sudden they'll change. They won't. They
Right.
follow the same pattern. So that's the true track record. And thanks for sharing your experience there. So take us through your journey. So what else, what other indicators you look into a sponsor to make sure that you're investing with the right person?
Yeah, a couple highlights that have really pronounced themselves,
Mm-hmm.
particularly over the last 2 years, Vinky. And thank you for sharing that comment on the pattern observation. That learning is such a on point comment because, yeah, humans, man, we are deeply habitual, and that includes the professionals that are out there. So that's why the second of our big buckets is approach. And what approach really means, to break it down more specifically in business language, is like uh, repeatable business process.
Mm-hmm.
And if someone can go and buy a storage facility, like we invest heavily into self-storage. We've done this with multiple sponsors over the years. It's treated us very well. And when they buy that storage facility, are they buying it climate controlled? Are they buying it not climate controlled? Are they going to do a certain playbook introducing technology to modernize the storage facility? Do they already know the vendors they're going to use? Because they're going to need something like 15 to 20 of them, to look
Mm-hmm.
holistically at when they go modernize a self-storage facility.
Mm-hmm.
Do they have the relationships, and how do they handle insurance premiums? Do they have relationships with insurers? The list is endless, of course, but
Mm-hmm.
a storage sponsor who's done that before doesn't need to go out and, come up with a blank piece of paper and suddenly scramble to come up with how they go do these things. They've done it before. And so, for a non-real estate example, I almost look at it like uh, when a human is going and learning an instrument. Like I play guitar here and there as a hobby. If I have to go learn a
Right.
really hard song or solo, I'm not a gifted savant. I actually have to sit down and practice a lot. And so if someone asked me, how the heck did you learn that really tricky solo? I'm going to walk them through step by step, every single step that I took,
To
everything I
get there.
get to get there,
Mm-hmm.
right? And so a sponsor can articulate that in great detail if they've done
Mm-hmm.
this before. And they can articulate that on paper, walking you through the financials, walking you through the operational plan. And so we look for that when it comes to approach. The one thing
Mm-hmm.
I'll say that is a bit controversial, from what I'm told, from when I'm just talking to other LPs that are out there and talking to folks that are in this industry, is that how does one look at, with an LP lens, like a blemish on a sponsor's track record, like if they didn't have a deal that went well? And here's my
Mm-hmm.
take on it. I actually get more nervous and hesitant to go into a deal with a sponsor if they have a completely perfect track record than if
Yeah.
they have a blemish or two. Uh, there's this question that I kind of test for, and you probably are familiar with this from our corporate experience, right? When you're interviewing a new person, I used to interview hundreds of people for, director roles to frontline folks and beyond. Behavioral interviewing, if you want to ask someone, tell me about a time when,
Hmm.
like those really annoying, challenging interview questions, ask a sponsor this failure response question, like
Hmm.
walk me through a time when a deal didn't go well. What happened? Follow up questions galore, and then ask them what did they learn from it. And it's amazing what is revealed by that moment, Vinky. Like when I've asked that to sponsors, and they will walk through and say, literally, I've had a sponsor say, you know what, we've never really hit a challenge like that, and I'm like, well, there's really only two possibilities for that answer. Number one is that they're more inexperienced than they're showing, or they're not being honest. And in both cases, I don't love that answer. So I would rather have someone have gone through that challenge, have gone through a really challenging landscape or a project. And I'm okay if they're an entrepreneur pre real estate and they didn't necessarily even hit that headwind in real estate, but they're upfront with their really tough challenges because they know everyone's got a plan until they get punched in the face, right? Which is that that Mike Tyson quote. Stuff happens on 100% of the LP positions that I've invested in, even the great ones. Weird stuff happens. A water main breaks. A act of God comes in and burns down because of lightning strikes one piece of a building and there's a fire, right? Like stuff just happens. So how does the sponsor react? And that comes from actually seeing how they approach these deals in the past. And it's okay if they have a blemish. I just want to hear them speak to it.
This is so funny that you're saying that. So I'm going to read you this code. I have it in my email. When my email goes out, I have something in there that says life is 10% what happens to you, and 90% is how you react to it.
Oh,
So
yes.
this kind of relates to what you are sharing with us because until unless something happened, a challenging situation came, you won't know the reaction of the sponsor or whoever you're trying to work with. If everything is hunky dory, it's going to be always good.
Yes.
But until unless you face that challenge and how you respond to it, not react to it, because 90% of the time it's a reaction. And reaction is not good. We know that, right? So this
Totally.
is one of the red flag that you shared with us. So share with us what other red flags you have encountered going through this approach. The first one
Hmm.
was the track record, second was approach, these two steps out of your bucket. So what other red flags you spotted?
Yeah, let's go through comms and just communications. I think
Hmm.
this day and age, it's actually rather easy for any business owner out there, any
Hmm.
sponsor, to sign up for a MailChimp account or Active Campaign account. Someone they can sign up and begin to communicate very transparently and quickly in a professional way. And so when I'm signing up and potentially investing with a new sponsor, I'm just requesting, hey, can I take a look at some of the updates and financial reporting that you've shared on prior deals that are active out there? And it is such a telling step. It is very easy for a sponsor to hit send on an email when things are good. I think
Hmm.
it's ideal to figure out, well, what happens when there is less optimal events happening? Can you get an example of when they had to communicate out something bad, let's say, or if
Hmm.
there's distribution pauses? There should be no shortage of examples out there, unfortunately. That's a
Hmm.
reality for those of us that have invested for the last 7 years in particular, and over the last two. There's some deals where I've had pause distribution. So when I approach a sponsor, I want to see how do they communicate the bad news? Because bad news, you can deliver it quickly, and
Hmm.
that's what's expected. You don't want to hide stuff. On the financials, I would say that the bar that we have set internally for ourselves on
Hmm.
what is considered acceptable on modern financial reporting has been very clarified and raised since back in 2018 2019. Because I mean, as a guy that worked at companies for 13 years that were all quote unquote fintech financial tech, like I've seen how quickly and easily folks can put together a good looking spreadsheet, and it's really not rocket science. So when you ask a sponsor, and I'm asking a sponsor before I invest, like, hey, can you send me an example of your quarterly reporting and financials, or show me the pro forma
Hmm.
for this deal I'm about to invest in with $100,000. Uh,
Hmm.
if there is, for whatever reason, number one, a hesitation, major red flag. Number two, if you get the pro forma, like this, here's an example from just the other day. We were about to invest with a really great sponsor. It's a self-storage sponsor. I'm a big fan of the team themselves. Unfortunately, we got a pro forma, and let's just say like the numbers could have been accurate, but the formatting was it was really rough, right? I mean, and I'm not the guy who says like, oh, I'm going to walk away from an amazing deal in investing in a piece of real estate because it looks like they've got a couple font sizes or they got, Helvetica on one row and like, like Roboto font on another. Like it does, I don't care so much about that. I'm not that neurotic, but it's basic stuff. Like it has to be legible, it has to be understandable, and like that speaks volumes about how people operate as professionals and how if they're going to be a steward of your six figures of your $100,000, $50,000, they are reflecting their professionalism in those basic choices of how they put information out there. So for communication, I would absolutely say it's those things. It's like timeliness and bad communication, as well as financial transparency. Greg, one other example I'll share that's more important than now than ever, Vinky, is that we're big on private credit right now. Like it's just perfect time in the market for it. We took 6 months of looking at these different sponsors that had been putting together private credit, private debt funds, and there's a lot that popped up out of the woodwork, right, in the last few years because there are people just jumping into the space to try to capture the opportunity. And then there's those who have been doing it for a long time already. And those are the ones we want to invest with. The one we ended up going with has done annual third-party audited financials for over a decade for the debt funds they've already been managing for over a decade. And that's like the gold standard to me. Like on many of the individual syndication deals that we see, it's not market norm to find like third-party audited financials. So I'm not saying that that's something that we're hard requiring on every deal, but on funds like that, a fund can be pretty opaque, like hard to really see what's happening on the inner works. And so getting something like third-party audited financials is incredibly powerful to just put us as investors at ease. So I think in terms of communication, it's a hefty bucket, but it's very doable for sponsors to actually go and put together those types of communications. I can go through maybe one more, but I don't want to nerd out too hard that I put people to sleep. So you tell me if it would be
No,
helpful.
that's
Okay. I mean,
experience. And I just feel like you're talking my language because I do the same thing too. Because when I had to work with somebody, I wanted to get on to their monthly reporting, monthly or quarterly, whatever they are sending out, to see their style, what they're
yes.
communicating to their investors. So please go ahead and share your next example as well.
Cool. Yeah, I think this is one that's qualitative, and I know a lot of the heavier quantitative, quant focused LPs, folks from my network who are in tech that are quant first.
Mhm,
They at first glance find this criteria to be squishy
mhm,
and less meaningful, and I do my absolute best to educate them as to why this is nothing squishy whatsoever. This is as firm as it gets when it comes to vetting, and that is values.
mhm,
And what I mean by values, you're going to have to lean on, and I lean on behavioral interviewing
mhm,
heavily, in addition to some of the basic stuff you can just find with a good Google search and with a background check, because those are the table stakes. We do a background check, civil, criminal on all the GPs that we now invest with. That's basic stuff. Like we've never had an exciting background check. That's a good thing. You want boring. But on values, uh, if I'm investing in multifamily or if it's or some type of asset where people live there, like this is a part of their family's safety and their well-being. I know we're all capitalists here. We're investing money to generate a profit. I'm not going to act like I'm righteous or better than someone else because of this, but I do care that the people who are living in this 200 unit, 400 unit apartment community that we're investing in, that they have a basic living experience that's going to be good, that they're safe, that they have a place for their family to be housed, right? Depending on the asset, depending on the market. And asking that sponsor, and this is a real response I got one time.
mhm,
Um, can you walk me through your philosophy on the tenant living experience you're trying to provide?
mhm,
And I will come back and ask the same question. If I don't get an answer the first time, I'll ask it about two or three different ways. And if I still don't get it, then eventually you have to just kind of raise your hands up and say, okay, we're not going to get it. So I didn't get a good answer on that. And that was a sponsor that we were really far along in like their deals, like the markets they focus on.
mhm.
think their business acumen is off the charts, good track record. But if they're doing it and they couldn't care less about the people living there, at least in terms of how I'm trying to get at the heart of this, well, that's going to be a problem. I think about right after the interest rate spikes that we saw in 2022 at the beginning of that cycle. Uh, Wall Street Journal had at least one piece that was big, talking about the most famous of multifamily portfolios that imploded, and this was the Apple's Way debacle that happened in Texas. Um, that is one of many examples that came out of the woodwork in the past few years, where you literally had people and families in a apartment community that had boarded up windows. They didn't have window repair, they didn't have HVAC correctly working, so they didn't have air conditioning and heating, and this is in markets that have real seasons like the, like I've lived outside of California for a good decade, and I know when it gets cold you can't have a big piece of plywood keeping your family warm. Like that is unacceptable, to the maximum degree. So like that's the type of stuff that at least at a initial like vetting process does matter to us and to me. um
Yeah.
it's a little different if you're investing in storage because no one's living in the units, hopefully, but
That's so true. Yeah, that's what I was going to say. Story units are better because nobody's living there, just storing the stuff. But I think you're so right about that because all these operators are the people that you're working with, the team as a team. Because if you're co-GPing with somebody, you're becoming part of the team. So it has to have some kind of empathy. It's like some people call it, okay, I'm giving back. But the thing is, overall, you're trying to create a community. When people are renting from you, it's not just like you're just renting it, taking the money, and you don't have any responsibility after that. And I don't like that either, too. In our corporate world, too, remember how we have a social responsibility to
yes.
give back, to create a difference as a human being. You need to have that. It has to be part of your innate nature somewhere, somehow. It is there. Everybody has that. But some people they just forget about it, or they just kind of shove it somewhere under the rug totally, and then not pay attention to that. But that insect is there in everybody. And then when you think about that, when you connect to that, I think that's the best way of doing business. Because then it's not just you're growing or expanding, it's just like a complete growth, kind of inside
Yes.
out. That's the way I look at it. So let me ask you this, since we're talking about the financials and then being empathetic and being trying to create the communities or connecting with people who are your tenants or your renters. So for the sponsor perspective, when you're trying to get a sponsor, how do you determine if the sponsor's financial interest align with your interest?
Mm,
I mean, that's
gosh.
very important to me, because if their interest is aligned to me or to my investors, because I'm kind of liable for my investors to bringing them into a certain deal.
Absolutely. And this is one of those most important fundamentals within the vetting process, to your point. And you stated it so well, right? And this comes down to incentives. Incentives drive human behavior at the
Mm-hmm.
most fundamental level, whether it's how much a person in a company makes a salary or their annual bonus, or if someone's on a
Mm-hmm.
sales team and they get a quota on a sponsor or a GP, is putting together their financial structure for this investment vehicle I might invest in. I'm looking at a couple things. I'm looking at the profit split or the waterfall, and I'm also
Mm-hmm.
looking at the fee structure.
Mm-hmm.
So for the fee structure, there's a couple things there that are just good market norms, acquisition fees, asset management fees.
Mm-hmm.
And there's a couple others that are less common, but you still see them, like disposition fees, right? The ranges I'm generally looking for on the acquisition fee is going to be, I'd certainly look harder at it if it was more than 3%. Like there has to be, for every fee, there has to be a business rationale behind it. And that's
Mm-hmm.
why as someone evolves in their journey as an LP and they're learning how to vet better, I would also caution folks against being dogmatic about it, right? Like if you come in and you think, oh, I'm only going to be doing deals that has a 2% acquisition fee or less. Well, that it's overly simple, because there's some heavy lift renovation plans that might actually be accounting for that. If the sponsor
Mm-hmm.
wants to go and buy a 1960s building, they're going to be doing a complete heavy value add, maybe even building some new stuff. Maybe they're putting some of those costs into their acquisition fee up front. We don't know, right? Until you look closer. And so, but generally, we're looking for acquisition fees within that reasonable range of like 1 to 3, just to give an example. On the profit sharing or the split, making sure that the incentives are aligned, that if this whole thing goes well,
Mm-hmm.
that's really going to be reflected in how the GP team, the sponsor team, is going to make the lion's share of their economic outcomes. And usually that comes up in the form of the promote or the GP equity shares. So you have seen hundreds, I've seen hundreds of investment summaries that say, here's the structures we like to see, usually like a preferred return at the which helps ensure the LP is paid back
Mm-hmm.
first on an annual basis to a certain percent before
Mm-hmm.
profit sharing kicks in to the GP. And we also want to see that when the profit split does kick in, it's based on something that is a strong performance in that business plan. That it's not going to just kick into something like a 50-50 profit share just because they happen to kick the deal off in the first place, right? It's there's different ways to skin this cat, but those are the types of things that we're certainly looking for, is making sure that or aligned incentives with a positive win on the business plan, and then the sponsor gets to celebrate and pop champagne.
I like that. Before the recording too, like you were talking about earlier, I think in different contexts, you mentioned you get what you negotiate.
Yeah, that's
That's
exactly right.
beautiful. That's exactly right. Because it does not matter what situation you're in. Because the other thing is, you have to pay attention closely how much the fees are charged. And some people, they just get carried away 100%. They're like, this is my money. Why should I pay the sponsor, or why should I pay the operator, this and that, like 100% come to me. But the thing is, investors have to understand that nobody's going to work for free, right?
That's right.
If you're giving somebody less fee, the work is going to be not that great either. So deal
Mhm.
might take even 10 years to exit instead of 5 years, because somebody has to make money somewhere. So it has to be reasonable at both end, like you said earlier. So there's like certain industry standard percentage, you should look for that and then see what the business plan is, how much is involved, and what their track record is like. They're going to go back to that, their track record, their approach, communication style. Those are the three things we talked about earlier. So you have two more things in your bucket that you're gonna share, but I'm
Great.
gonna ask you this at this point is, what aspects of sponsors risk management approach do you scrutinize, during your um,
Mm.
investing evaluation?
Ooh, that's a great question, Vinky. I'll try to keep this one concise because there's so many angles on it. One of the things that we doubled down on after the last couple of years of more painful learnings in the market, right? Like the
Mhm.
rising tide raises all ships, and also when that tide recedes, you find out who's swimming naked, as the platitude goes. And two things on the financial wherewithal. Number one, I want to understand that business itself, like the sponsor's business,
Mhm.
has financial wherewithal. Like, are they as a business in a stable place?
Mhm.
And you can do that with financial review. You can also do that by looking at the performance of their current portfolio. If
Mhm.
they're facing major challenges like foreclosures or challenges in other parts of portfolio, but still doing new deals, you have to factor that in. Um,
Mhm.
One other one that we did not used to look at years ago, we look at it now, uh, and I want to give this with a big caveat or asterisk for the hardworking newer sponsors that are out there just trying their absolute best to do good work, which is um, we look at the personal balance sheet and the personal financial situation of the sponsors themselves. Meaning, uh,
Mhm.
it matters if these sponsors need this one deal to go well to put food on the table for their family. That is a major risk for the
Mhm.
judgment that is going to be applied during this business plan.
Mhm.
Whether it's inside of a company and someone is running a big business unit, or if it's someone managing a piece of real estate with a couple hundred units and people living in this property, uh, we need someone who is looking at a situation with even keel, level headed temperament and sound business judgment. And
Mhm.
how the heck is someone supposed to have those things from a judgment perspective if they think I need this deal to go well, or I can't put my kid through college, or I can't put food on the table? That is compromised judgment at the highest level.
Mhm.
Um, so we were on the most recent fund, like we're working on a private credit fund right now with a really great partner, and I confirmed, like, are the individual GP members meeting qualified purchaser status, which is just one of a few different statuses out there, that they have millions of dollars of investable assets. And that's just really good to hear, because that means that they are not riding all of their life on just this one fund that they're doing.
Mhm.
So
Yeah,
those
exactly.
things matter a lot on risk mitigation as the financial picture. I think that the other thing you can do for risk mitigation is just reserves.
Mm-hmm.
Financial reserves, substantial cash reserves, operating reserves for the deals themselves, because things happen. We've had trees fall on a building in one of the deals we invested in. We've had like multiple fires. Insurance. Great insurance.
Insurance is in place for that to take care of that. Yeah,
Yeah,
definitely.
like great insurance coverage is more important now than ever, particularly if investing in places that are climate jeopardized, like the Southeast. And we're seeing a lot more of that pain right now, and in California, frankly, in Southern California in particular. So those things matter. Probably like for now, without going too much nerdier on it, but I have to just make sure that I share this is, I mean, for risk mitigation, when it comes to legal and compliance,
Uh-huh.
how is that team conducting itself in terms of professionalism on the legal and securities front?
Mhm.
Because uh, there's there's rules. There's rules that are there to protect investors. There are rules that are out there to ensure that things are being done correctly. And if you see that a sponsor is, guaranteeing returns, or if you see a sponsor is structuring deals in ways and communicating in ways that are unprofessional, those are things that are very risky. And not only are they risky for the sponsor, they risk the deal itself. Um,
That's true. Hmm.
so I look at those types of things as pretty important risk mitigation. And it has to say, this is like the comment of all comments on risk mitigation, but the debt structure. I
Yeah,
mean,
that's good.
yeah, it's
So,
huge, huge. Like make sure that the debt and the loans used in those deals are structured for the particular business plan conservatively, because there's painful learnings out there. I mean, I'm in some deals where great team, great sponsor, great real estate asset, but unfortunately, no one out there in 2020, before 2022, no one had in their forecast that the interest rates were going to go up by 300 basis points within like an
I
18-month
know.
period. No one forecasted that. I don't care what kind of told you so soapbox or people are out there saying it otherwise. No one had that in their forecast. So that is important.
It is important, yeah. And I know we are out of time. We are like way over time. So I know we talk about multiple things, and the exit strategies are very important too. You might want to pay attention
Yes,
to that too. So if you wanted to touch that before we move on to our rapid fire round.
absolutely. And thank you for going there. Exit strategy, if you really had to tie it in a bow, is kind of everything, right? Uh, Understanding and asking that sponsor to articulate very clearly, like let's say on a multifamily asset, when they say, "Oh, we're going to sell to a buyer," well, what type, right?
Mm-hmm.
Uh, are they an institutional buyer? Are they institutional buyer of what size? Do they usually, and why do they find this asset appealing in the particular time period you're planning to exit? Completely different business plan
Mm-hmm.
than, for example, a self-storage sponsor. We've invested in three of those sponsors, many funds and deals individually. The business plans at a high level are similar, though. Buy a big portfolio, build some, package them up into a big portfolio of maybe 30, 35 storage facilities under one brand name, modernize them, make them efficient, low expense, increase their revenues in whatever ways you can, primarily through rents, sell the whole portfolio to a large institutional buyer, which is maybe one of the top five, top 10 self-storage buyers, or perhaps it's just a large other form of, there's family offices, there's institutional sovereign funds, like there's all kinds of crazy options for buyers on the other side of that, but they have to be able to articulate how the heck they're going to do that. And if they don't have an answer to that, and it's kind of just like a wish and a hope, I mean, hope is not a plan. So you really have to
I
mitigate
agree on
proactively.
that. Plan. And hope is a hopeless world, anyways. I don't like that.
Yeah, right.
Seriously, that's a good one. And then you need to have multiple strategies. If a sponsor comes with you and tells you he has a multiple strategies, not just one, and that could be more appealing to you. So
Very
at this
much
point,
so.
I'm going to ask you, share one golden nugget with my audience, like you didn't share enough, but share one more golden nugget. Could be mindset, could be anything.
Yeah, I mean, I think the best piece of advice that I have to tell myself every time, and literally every time before I invest again, is ask the question, what's the goal for the money?
Mm-hmm.
And what I mean by that very simply is that you can invest for growth, you can invest for cash flow or income, and it's a forcing function to sit there and say, okay, if I'm investing 100K into this deal, like I just invested 100K into private credit with the sponsor we're working with on our private credit fund, and I'm doing that in my retirement account because I'm okay with growth from this. I don't need the cash flow for that particular investment. But like everybody else, I mean, I'm a human, and when I see a beautiful looking set of pictures in this investment summary come across the desk, the pro forma says 30% projected IRR within a 5-year period. My lizard brain triggers and I say,
Mhm.
"Oh, that sounds really good." And I forget, "Oh, wait, do we have we earmarked this 100K for cash flow
Mhm.
or have we earmarked that for growth?
Mhm.
And by when?" And it's always, a reminder for me whenever I'm connecting with a new LP and I'm helping educate them on this stuff, just to kind of slow things down. And these are brilliant investors, way smarter than me. We were talking data scientists, folks that come from tech,
Mhm.
software engineers. They know their stuff in and out, but they haven't stopped to think, oh, I'm not just going to quote unquote diversify. I need to think about what do I want the input versus output to be for this investment, this allocation I'm going to make.
Yeah, that's a really good golden nugget right there because you need to create a version for yourself. Even it's a smaller one, like a goal you said. What
Yes.
is the goal for your money? How far you wanted to reach there and what you wanted to do after. And that is very important too. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer it in one word or one sentence only. Are you ready?
Ready.
Okay, share with me one of the most important things that you've learned in your life and how did your life change after learning it?
How to say no gracefully in service of the top priority at the moment. And
I like that.
yeah, I mean, and I learned that from a great book. I've gone through it 3 times already. It's called Essentialism by Greg McCune, and it goes through 5 ways to just say no in service of keeping your social graces intact at the same time. And it's hard, right? No one likes to say no to a coworker when they say, "Hey, you want to come to happy hour?" No one wants to go and say, "Hey, you want to go and have fun and play pickleball?" And stopping and saying, "Oh, I have commitments to go to my son's basketball game. Oh, I have commitments to go work on this particular underwrite for our business because I owe this to our investors." Right? Like that is doesn't feel good in the moment, but it's you have to learn how to say no.
I like that. And you answer 2 questions in one shot. My next question was a good book. And then you said the book name is
Oh,
Essentialism.
yeah, yeah. Sorry, I jumped the gun. Yeah, Essentialism by Greg McCune.
Thank you so much. So we're going to move on to question number 3. In one word, what does life mean to you?
Oof. Intention. Um, I think that finding intention is key for everybody, and that means something different to everybody. But intention would be my word.
I like that. I like that. It has to be the right intention too in the right moment.
Right.
That's very
Exactly.
important. And what is your biggest passion?
I mean, biggest passion is my family. I think that if I think to our lifestyle now and what we've worked so hard to build and still work hard now compared to 13 years ago, 15 years ago, uh, last summer, as an example, we traveled to live in a different country for 6 weeks with the whole family. I have 2 sons that are 10 and 7. This is not sitting on a beach. This is, working and living abroad. And we did that in the Balkans, in Croatia and Montenegro last summer. 2 summers ago, this was the first time we'd ever done any of this crazy stuff. And we went and lived in Portugal. And so
Wow.
these are things that were scary. They were not possible when I was working full time and Jennifer was working full time, and we work hard still. But it's about being intentional again, and choosing to go and focus on what matters most to us in action, and that means putting the family's experiences first.
That's true. And what an experience. Oh my God, kudos to you. What a good parenting right there, exposing your kids at this age to all these things and traveling and living in the other countries because that expands your brain. And we
Yes,
all know that when you expand your brain, it never goes back. So you're
exactly.
creating the life for them that you can't even imagine what's going to happen as they're going to grow up. Congrats to you, to your wife as well. So last question, if you could turn back in time and talk to your younger self, what would you tell yourself and why?
I mean, I'm half joking when I say this, but you know, I was living in Denver, Colorado, and you know, in the early 2000s, but also particularly within you know, 2009 and 2010. Why was I paying rent? I should have bought everything in front of me. I didn't buy any real estate, you know, until we bought
Mhm.
our home, which is a huge milestone for us, you know, like 2013 in the Bay Area. And I'm so grateful we did it when we did it. But I wish, oh my gosh, do I wish I had bought some real estate back then? Or frankly, as a huge gamer, I wish I had the foresight to just buy some NVIDIA. Uh, but you know, hindsight is 2020, right?
So how can people reach out to you?
Yeah, folks can reach out to me at madisoninvesting.com and they can just request an invite to our investing club. And you know, they do have to have a conversation with me, but I really cherish having those types of strategy calls.
Thank you, Spencer. I really enjoyed our conversation. I'll have you back one of these days because we didn't get to, I think, I have a lot more questions. We didn't get to touch all the questions and then, yeah, short of time today. But thanks again for coming to my show. And as always, thank you everyone for tuning in to the Real Estate Vibe Show. Don't forget to subscribe, leave a review, and share this episode with anyone looking to elevate their real estate investing game. Until next time, stay focused, stay inspired, and keep building your real estate vibe. Thanks again.